Good evening, ladies and gentlemen. For those of you that are joining us for the first time, ETX is a regulated provider, so I'm required by law to give you what's called a risk warning. So let me read that and get it out of the way. Trading in the financial markets can result in the loss of the amount invested. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. All information that is provided in this webinar is for educational purposes only. ETX Capital and the presenter are not financial or investment advisors, and we do not recommend any securities or instruments. Any securities we talk about tonight are for educational purposes only. And for those of you that are joining us through the internet and don't know much about ETX, we are a fast-growing financial services company based in London. We are authorized and regulated by the FCA, that's the Financial Conduct Authority, and we're also a member firm of the London Stock Exchange. When you trade with ETX, you can trade on our web browser called Trader Pro. You can use the ETX MT4 platform or our all-new ETX binary options platform. It's up to you. You can trade on all of them, one of them. You can trade Forex, CFDs, currency. You can trade stocks and indices. You can trade CFDs as well as spread betting if you're based in the UK. So, welcome to our class, the ABCs of Japanese Candlesticks. Now tonight is a two-part series. Tonight, in the first part of the class, or this series is a two-part series, this week and next week, tonight we're going to be discussing the basics and understanding of what Japanese candlesticks are and how to read them and understand the patterns. And next week we're going to actually be doing more actual seeing how to use them for exit points and entry points and to figure into your trading strategy. Now, tonight's class is being recorded, and you should receive after class an email with the link to the recording. Now, candlesticks are a form of charting developed by Japanese rice traders in the 17th century. So it's been around a very, very long time. The thing is that candlesticks are part of a larger trading system. Now, they were only used by professional traders for a long time because putting a candlestick on a chart is quite time consuming. And before we had all of these computerized Java charts and HTML charts, and we charted by hand, drawing candlesticks was very complicated and time consuming. And today, in retail trading, they're a buzzword. And so many new traders come to me and say, Barry, I'm using Japanese candlesticks. I'll say, where'd you learn how to use them? Oh, no, they're easy. Yeah, because you push a button on the chart, you see reds and greens, and you think they're trying to tell you something. But candlesticks are a lot more complicated than that. Now, if you spend the time learning the basics, they are a great trading system as well as a trading strategy. But you have to understand what they're saying because the reds and the greens are virtually unimportant. Each candlestick represents a data set of a complete price action during a selected time frame. So if you're looking at a 15-minute chart, it's all the price action that took place in that 15 minutes. If you're looking at a one-day chart, it's covering all the action of the one day. In a diagram we'll look at shortly, you can see a green candle and a red one, both having wicks at either end, and the actual main body of the candle represents the relationship between the open and the close, and the upper wick in each case represents the high, and the lower wick represents the low. So the construction of a candle is quite simple. It's very much like a bar chart because it's got OHLC, the open, the high, the low, and the close. So when you want to draw a candlestick, if you're looking at a 15-minute chart, at the open of that 15 minutes, you would draw a line across. At the close of that 15-minute period, you would draw another line across. You would then take and put a dot at the highest point that asset achieved during that period, and a dot at the lowest point. Then you would connect these dots to the lines, and you would then form what's called the body of the candle. The portions outside the candle, up to the high and the low, are called wicks, or sometimes they're called shadows. Okay. And if the candle is, you would have to decide whether the candle is red or green, or black or white. You decide the color system. It's a bullish candle and a bearish candle. In the old days, they were just black and white. In today's charts, we use, because they're popular and the charts can do them easily for you, we use reds and greens. So reds are a bearish signal. If you climb down from the open to the close, you have a bearish candle, and therefore color it in red. If you climbed up from the open to the close, you would have a bullish candle, and you would color it in with green. So as you can see, actually filling in or making the candle isn't quite difficult. Now, each one of these candles, though, tells a story. And understanding the story that it's telling you about the markets is very, very important. So I prefer using bar charts. It's my trading method for years and years and years, because I started trading back when you had to chart by hand. Today, I flip more and use both, but I start out drawing everything on my charts with a bar chart, and then I push a button and convert it over to candlesticks. But candlesticks are very important. A bar chart simply tells you the same information, OHLC. The difference between candlesticks and bar charts is candlesticks have a relationship between, and this is a misconception, it's not about the reds and greens. It's about the size of the bodies and the wicks. And these tell you a story. So what does the size and the shape of the candle tell you? Now, there are 6 variations, and they're telling you the story of the bulls and the bears. They're telling you what happened and who controlled the market in that time period. And what we can see here are 6 variations. So I'm going to use the story of a football game. It makes it very easy to tell the story. In the first candle, we can see that we had an open here. We had the close here. We had a high here and a low here. What ended up happening is we had a fairly large candle, and the candle's white because what happened is the open was lower than the close, so the market moved up. So that's telling you the bulls were in control of the market for that period. Now we can see that it has an even-sided wick on each story. Okay, so yeah, you're going to have a time where somebody has a little bit, somebody was able to get the ball, run back a little bit, somebody catch the ball and turned around the next play. But for the overall game, the bulls were in control. And they ended the session in control. Where in number 2 is exactly the opposite. The bears were in control. In number 3, which represents a small body and small, evenly sized wicks, tells you that nobody was in control. The small indicates that no team was in control and could move the ball in that session. Now, that's not telling you that the bulls or the bears lost control of the market. Just maybe the bulls got tired after a big long session. Maybe the bears, were exhausted from their long session. It's just telling you nobody controlled that trading period. So if you're looking at a 15-minute chart, for that 15 minutes, nobody was in control. Then we go to number 4, which you see has the same body size, and it doesn't have to be this exact body size. It's a small body size. Okay, that means the open and the close were fairly close, but we had a long downward wick. So a long shadow indicates the bears controlled the ball for part of the game, but lost that control at the end, and the bulls made an impressive comeback. In number 5, we have just the opposite. The bulls were in control, but the bears came back and were able to end up dominating at the end of the session. Number 6, we have a long upper and lower wick with a small candle. That's telling us that neither the bulls or the bears ended up dominating, but both of them had moments of control. But at the end, it was a standoff. So this is just telling you, each individual candle tells you a simple story about the market and who's in control. You can imagine if you want a tug of war and there's two teams on either side pulling. Where was the teams? They were evenly matched, but at some given point, the guy on the right-hand side tugged a little bit harder and pulled a little bit, but then the guy on the left-hand side pulled back a little bit more. But who ended up controlling it throughout the match? Okay. So it's giving you some information about understanding this eternal fight that's going on in the markets. And you have to understand who is in control before you can make any type of trading decision. But this is just the first step of candlesticks. But don't get yourself lost in the psychological response to a group of reds and greens. Because what happens, if you see lots of blacks and whites, you see lots of reds and greens, we're human beings. And psychologically, we see lots of reds on a chart. We just think it's negative or down, and we think the market's moving down. That's not true. So don't let your mind sway you. Don't let yourself misunderstand what you're seeing. And unfortunately, this is what a lot of newbie traders do. They don't understand really Japanese candlesticks, and they see all these little colored pretty things on a chart. Oh, look at that. I should be trading that asset down, when they could be completely wrong. Okay. So we always have to look at the bodies and the wicks or the shadows, because they tell us something. Now, basically the wicks tell us who was able to pull a little bit in control on each side. Now, remember, they're sometimes called shadows. Okay. So candlesticks with a long upper shadow and a short lower shadow indicates that buyers dominated the session and that bid prices were higher. However, sellers later forced prices back down from their highs, or a weak close created a long upper shadow. Conversely, candlesticks with long lower shadows and short upper shadows indicate that sellers dominated during the session and drove prices lower. However, buyers later resurfaced to bid prices higher by the end of the session. Now, this is just the basics of the story candlesticks are telling. Now we have to move on to the next step of understanding candles. And these take place in the formation, or what the shape of the candle and its wicks, or the formation of specific type candles are coming. And these are, we're going to talk about individual candle patterns. Okay. And sometimes the formation of a particular candle will tell you something very specific besides about the battle of the bulls and the bears. Now, the first candle that's very important that we look for often is called the Marabuzu. Okay, a Marabuzu is a very popular candle, but tells you something very precise about the market. A Marabuzu has no wicks. So therefore, what happened is if it's a green Marabuzu or a bullish Marabuzu, is that at the beginning of that session, the bulls took control and they did not ease up for a second. And that's why you have no wicks on either side. So this is telling you that the bulls have complete control of the marketplace. Now, these are called patterns. Okay. This is an individual candlestick pattern. It's different than just being able to tell the story about the fight of the bulls and the bears, because when we see a Marabuzu, we're going to expect something to happen next. So you have red Marabuzus or red and green ones, bullish and bearish ones. Okay. Now, even more potent than long candlesticks are Marabuzu brothers, black and white or red and green. Marabuzus do not have upper or lower shadows, and the high and the low are represented by the open and the close. A white Marabuzu or a bullish Marabuzu forms when the open equals the low and the close equals the high. This indicates that the buyers controlled the price action from the first trade to the last trade. When you see a Marabuzu appear in a chart, we're expecting this to tell us it's a continuation of a trend. So in the case that we're looking at in a bullish Marabuzu, we had an upward trend which got involved in a little bit of congestion. Okay. When we see that Marabuzu develop, that's telling us we're moving back and that upward trend is going to remain forward. So because a lot of times you have congestion, you have ease, you have a weak trend. So it's always important to look at how these candles, not just the Marabuzu, but all of them, where they appear in a trend. But when you see the bullish Marabuzu, it's going to tell you you're moving back into an uptrend from a congested pattern. When you see a bearish Marabuzu, you're going to move into a strong downtrend. It's best used when coming out of an area of congestion or an area of sideways trading. Okay. Then we go to something called spinning tops. Now, remembering these weird names isn't all that important. Remembering when you see the patterns, what they're trying to tell you. Candlesticks with long upper shadows and long lower shadows as small real bodies are called spinning tops. One long shadow represents a reversal of sorts. Spinning tops represent indecision. The small real body, when followed, hollow or filled, whether it's bullish or bearish, shows little movement from the open to the close, and the shadows indicate that both bulls and bears were active during the session. Even though the session opened and closed with little change, prices moved significantly higher and lower in the meantime. Okay. So as opposed, you need to have these not with short upper and lower shadows, but long upper and lower shadows. Then we move to one of the most common and the one most talked about the most often. It's called the Doji. The Doji is a complete, tells you completely that the buyers, the buyers and sellers have no idea. They're not just indecisive. They don't have any idea. They're not making, nobody's controlling the market. Nobody's pushing the market. Nobody's doing anything. It's a total sense of indecision. A doji is formed when the open and the close are virtually the same. Now you could have a very narrow, tiny body because, you know, these things move in pips. But in most cases, you're going to see a straight line over a cross. You're going to see equal size shadows in most cases. But there are lots of dojis, we're going to talk about those, that have long shadows on either side. The doji is more about the size of the body. In most cases, the open and the close were virtually the same. But again, especially like in currencies, when you're trading the thousands of a pip, you know, you can have the small sliver of a candle, but it's a small, tiny line. But then you also have dojis that have very long wicks in either direction. Okay. Sometimes there's a little bit something that causes an instantaneous volatility in the market, or sometimes assets trade in larger numbers. So when you see, you know, when somebody sells something down, it doesn't move in a pip like gold when it drops $1 and then goes right back up is insignificant. So you have to look at what the asset is and how much it's moving. But then we want to look, once we start seeing the doji, is where it appears. The relevance of a doji depends on the preceding trend or the preceding candle. And it's always important to look, even though you look at these and see these appearing, is where they appear. Where are they in an uptrend? Are they in a downtrend? Are they in a congestion? Are they in a weak trend? Because all of these will lay into your overall interpretation. But after an advance or long white candle, or the opposite in a downward climb, a doji signal says the buying pressure is starting to weaken. So in other words, the market is pushing up and you have this big white-bodied candle or this green-bodied candle, and then a doji appears. It's telling you that the bulls have kind of left the market. They either got exhausted or all bought out in that prior segment, or they might be resting. So we want to look also if the candlestick pushed up, if the shadow pushed up or didn't push up. Dojis indicate that the forces of supply and demand are becoming more evenly matched and a change in trend may be near. Dojis alone are not enough to mark a reversal, and further confirmation may be warranted. After an advance or long white candle, a doji signals that buying pressure may be diminishing and the upward trend may be nearing an end. The doji is a candlestick where the open and the closing price are the same or almost the same. It can take many forms as shown depending on what the trading activity was in that period. What's key with a doji is that neither the bulls nor the bears controlled the market and that the prices ended up where it began. So you have to look at a doji in relationship to the trend and to the previous candle. So here in this chart you can see twice when dojis appeared. So we have a downtrending market. We have the two dojis that I've circled for you. And you want to look at those where they are. So we have a downtrending market. The prices bounce back up to the trend line, ease back off of there. We got the doji and they fell back down. They moved back up to the trend line and fell back off of there. But a doji alone does not tell you this. It's telling you we had a green, nice sized body candle preceding it, but it's telling you the buyers who controlled the previous candle had no control in the next candle, which is probably telling you that the downtrend will continue. But a single pattern candle doesn't tell you anything. It only is used as part of a bigger story. Now we will look at double and triple patterns because a single pattern candlestick, one candlestick, isn't enough to tell you anything. But we have doubles and we have triples when there's two candlesticks together that form something or three candlesticks that form a pattern, and then they get more precise in what they're telling you. So you even have long-legged dojis where you had huge push by the bulls, huge push by the bears, but they still ended up in the same place. So the ultimate story of the doji is they opened and closed at the same place. So here you have, and there, like I said, there's all kinds of weird names for this stuff. Okay, I gave you handouts in there that tell you and go over all of these. Here you have the dragonfly and the gravestone. They're only named based on what they look like, but the fact is they're dojis because the open and the close were the same. Okay, so before turning to the single and multiple candlestick patterns, there are a few general guidelines to cover, because you have to understand these. But now that you have a basic idea of what candlesticks indicate with their bodies and their wicks, let's cut our teeth on some simple, uncomplicated candlestick patterns. These are fairly common and quite likely to appear before you in a normal trading session. So knowing instantly what they mean and taking the proper trading decision immediately could make a decision between a winning and a losing trade. Now again, like I said, you don't have to remember the word doji or the word Marabuzu because we're going to go on to learn a lot more things. You don't have to remember. We're going to start talking about what Haramis are. We're going to talk about all kinds of triple crows and triple soldiers and all these names. What the names are unimportant. Is recognizing the patterns. Just because when you see a candlestick that has an open and a close that's the same, remembering that that's a doji isn't so significant. Remembering that it tells you there's complete indecisiveness in the market and could be signaling the reversal of a trend, that is what's important to remember. So we looked at what we call standalone candles, and these are based on the position of candlesticks. Now, one of the most popular ones is a star position. Now remember, we're not talking about now the shape of the candlestick. We're talking about the position of where it appears in relationship to the previous candle. A star candle is, in this case, the examples that we're looking at are relatively medium-sized bodies, but it could be a long body. But what they appear is they appear to gap away from the previous candle. So they appear like they're a star. Okay. So that's all that a star position means. A candlestick that gaps away from the previous candlestick is said to be in a star position. The first candlestick usually has a large real body, but not always. And the second candlestick is in the star position, has a small real body. Depending on the previous candle in the star position, candlesticks gap up and down and appear isolated from the previous action. That's all that a candlestick is. It appears that it's gapped away. Okay. Then we have shooting stars and inverted hammers. Okay. Now, again, they are medium body candles, and they're the exact opposite of each other. One are a downtrend, one are an uptrend. So a shooting star, as opposed to a star position, looks like it's a star falling from the heavens. Whether it's a red or a green or bearish or bullish, it's got a long upper wick and it's found in an uptrend. Where in a downtrend, they appear the same, but they're called inverted hammers. So you could take the two in the left chart and move them to the two in the right chart. They're not upside down. It's just they're appearing in the opposite trend. Okay. In the candlestick pattern, it consists of just one candle, although with candlesticks, it's always best to view them in the context of the candlesticks around them. The hammer or the hanging man candle has a long lower wick, short body, and a little or no upper wick. Strictly speaking, the lower wick should be at least 2 times longer than the body, and the longer the better. And depending on where you find it in the chart, it's called either the hammer or the hanging man. The hammer is found in a downtrend and signals a bullish reversal. So when you see a hammer, the trend is most likely over and is reversing upward. Now, again, you have to see where these appear, and you have to see whether the strength of the trend. If it's a weak trend and these appear, then they're not as distinguished or not as positive as when you have a strong trending market. Because, a lot of times you can have an uptrend or a downtrend that's kind of weak and moving almost just on a slight angle. Then you have other times where they're fairly steep or fairly well formed. Okay. The hanging man is the same as the hammer, but found in an uptrend. For each one of these things, there's a reversal for an uptrend and a downtrend. Okay, there's no hard, fast rule about what color a hammer or a hanging man has to be. The fact that they have short bodies already means that there's indecision coming into the marketplace. However, a green or white hammer and a red or black hammer are stronger market indicators. So again, in this case, in the chart you're looking at, you see a downtrend. You see the hammer form. Okay. In this case, it's a green hammer. It doesn't have to be, but you have the hammer. You have the very, very long shadow, the upper shadow, and it's indicating that the reversal might be happening. And in this case, it led into a reversal. Here we go to the next, on the right-hand side, we see the exact opposite. Now, again, you have all these in those handouts I gave you. It is just recognizing them. So when you see this type of candle develop, you know what that candle is trying to tell you. Not just the story of the bulls and the bears, but now what you're expecting the market reaction to be. Now, one of the most popular ones is called a Harami. The rules on a Harami vary. I use a very strict interpretation for Harami because they appear quite often. If you use the strictest of interpretations, they work extremely well. Now, the word Harami means pregnant. Okay. So therefore, what you have is you have a real body candle. The next candle is completely contained within the previous candle. Now, I say it must be all the wicks and all the body, because when you have a pregnant person, you don't have an arm sticking out the ear and or one sticking out, the belly button. Everything is contained within the body. Now, if I also use a very strict interpretation that the body of the next candle or the Harami position candle must be the opposite of the previous candle. Okay. I use this because it's a very strict interpretation. It doesn't have to be. So as you can see in this chart over here, if we were to draw the lines forward on the upper and the lower, or the open and the close of the previous candle, everything for the next candle is within that upper and lower. So it's actually formed in that body. But because this was an upward candle or a bullish candle, I say the next candle to indicate a market reversal has got to be bearish. But again, it's a small body candle. But there's no rule about how big the next candle has to be here. This candle can be huge. It just must be completely contained within the previous candle. Now, a Harami is one of the most common candlestick patterns you'll come across. So it's important to recognize, to understand what it means, and to understand its limitations. A Harami is a two-session reversal candle. It's made up of two candlesticks and applies that the price is about to turn. It is indicated by a small body of the opposite color, completely contained by the body of the previous color. Okay. This is my rule 100%. Okay. It is not essential for the two candles to be opposite colors, but this tends to give more reliable signal. Now, as you can see here, the body of the small white candle is completely confined within the body of the previous candle. This indicates that the upward trend is running out of steam. Okay. And again, you have a bullish and a bearish. The bullish Harami shows the sellers are beginning to dominate as they come back to the market, where the bearish Harami has a shadow that extends beyond the body of the previous candle. And in this example, and the minute it does that, I say it is not a Harami, okay? Because everything must be contained. Some traders would not regard this as a true Harami. However, its body is entirely within the previous green candle, and a reversal follows. Doesn't matter. You can make up all kinds of interpretations, but when you want to trade, you want to be precise. So I'll be blunt with you. Harami doesn't always live up to its hype. While it is touted as a reversal indicator, you may find yourself disappointed by its reliability. The psychology behind a Harami is that a possible change in sentiment may be happening. The small candle does not necessarily mean a strong reversal is coming. Often a Harami pattern will indicate several days of tight range trading, referred to congestion or consolidation, and will follow. A Harami on its own says the chart might reverse. Be aware of a Haramis and watch for what they're telling you about market sentiment, but don't trade them blindly. And in no candlestick pattern should you trade blindly. You should always use other indicators and in connection with how the trend is moving, what the previous and the next candle are, and understand what is going on with the market. Now, what have we looked at so far? We've learned how to build a candlestick chart. We understand reading and what a candlestick is actually telling you in the story of the bulls and the bears. We've explained the candle shapes and sizes. We've looked at the formation of the candle. We've looked at the position of the candle. We've talked about dojis. We've talked about haramis, tops and shadows, or wicks and shadows. We've talked about the fight of the bulls and the bears, and hammers and hanging man. This is just the beginnings. This is just the stuff you kind of got to know in the back of your mind at all times. And this is what I'm saying is just looking at reds and greens isn't what a candlestick chart is telling you. So now it's time to learn about multi-candlestick patterns. And I told you it was a lot more than just reds and greens on a chart. So we have standalone candles, and somebody's nicknamed them lonesome cowboys. These consist of a single candle. We talk about Marabuzu, spinning tops, Dojis, hammers, hanging man, inverted hammers, shooting stars. They just kind of tell you something about what might be happening in the markets. Then we go to double patterns or duos. These start giving you more precise information. These are a combination of two candles that occur simultaneously or one after another that tell you something precisely. And these include bullish engulfing and bearish engulfing, bullish tweezers and bearish tweezers. Then we're going to go on to the triples. And triples consist of morning stars, evening stars, three white soldiers, 3 black crows, 3 inside out, and 3 upside down. It's a lot of words. Okay, a lot of weird names. But the fact is, you don't have to remember the names. You just have to remember what the pattern is to tell you. Now, bullish engulfing and bearish engulfing are 2 of the most popular types of candles that traders rely upon. Bullish tweezers and bearish tweezers, the duos, happen very rarely. So when they do happen, you want to act on those. So again, I've given you these in your handouts. And there are 16 basic primary chart patterns that you should be able to pick out and see at all times. Okay. From there, next week we're going to talk about blending candles, where you can have a bullish engulfing and a hammer. Okay. Now these are not triples and doubles. These are 2 completely separate patterns that appear next to each other, and how you can add them together and multiply them. But right now, let's talk about the bullish and the bearish engulfing, the first of the duos. Okay. Now, as you can see on this chart, we have, and again, I will keep reiterating over and over, we have everything that has an upside has the reverse in a downside. So a bullish engulfing is the opposite of a bearish engulfing. A bullish engulfing candles are a pair of candles that indicates an impending market reversal, which may be bullish or bearish. It all depends on where the trend is. If you're in an uptrend or a downtrend. If the pattern appears at the end of a downtrend, it will comprise of a smallish red body candle, followed by a much longer green body candle, which has completely engulfed the previous candle, the previous red candle. This is the bullish engulfing candle on the left, which we'll go back and see in the other chart. And it shows the bulls have taken complete control of the marketplace as opposed to the move by the sellers. So what we have here is we have the red candle, as you see in the chart. The next candlestick has, and it can have a short wick or longer wick, it doesn't matter. What it must mean is that the body and the wicks fully engulf. They're the opposite color, and they fully uncover the entire move of the previous candle. In the opposite, and this is in a downtrend, when this appears, okay, what's happened is the bulls have now taken control of the market. This is not saying it's going to move to an immediate uptrend. It's saying that it's moving, that the buyers are taking control of the market. So here you saw this huge shift upward. Now, when we talk in next class, we're going to talk about how much percentage of price action we would see. So here we see this size of a candle. So we would expect an ease before it moves into the uptrend of about 50% of that candle. Because what happens is the bulls have just taken control. They've jumped in there head first. So they expire themselves. They take a breather. So the markets can bounce back to 50% of that push, and then they're going to move into that uptrend or the reversal. So here in a bearish engulfing candle, we have exactly the opposite. So you have to start out with the green candle because it was in an uptrend. All of a sudden, the bears take control. And again, we would look at 50% of this to retread, and then the downtrend would be verified by complete reversal. But at what point and what prices you want to consider entry and where to put your stop losses and take profits will come from the size of the candles and how much the move was. But this is a bullish and bearish engulfing, and they're very important candles because they indicate a strong market reversal is taking place. Now, tweezers are exactly like their names. Tweezers appear either in a downtrend or an uptrend. They must be opposite colors. So in a downtrend, you would first have a red or a bearish tweezer. Okay. It means that you have a median. It doesn't matter how big the body candle is, but there's no upper wick, and it's got a long lower wick. Then the next candle would have the same length or almost the same length wick, but it would end up in an opposite color body. Okay. This is telling you the bears have run out of steam and the buyers are starting to build back momentum. Okay. And they, to appear just like, and they look just like tweezers. So this rarely appears. Now, we could tie this to very important levels of support and resistance. So if your support level was down here and the price hit that support level and bounced off of it, that's what would have created them being equal. But it's a very significant number when both of those shadows are exactly the same. You also have it the exact opposite in an uptrend, and it reverses into a downtrend. Again, you can see the bodies of these tweezers are slightly bigger than the bodies of these tweezers. They must be identical in size, but they can be long bodies or short bodies. Now we go to some triple candles. The morning star, to me, is a long story of BS. It's a complicated pattern. I don't believe in it. It appears, and the story is it appears like the morning after the dark and before the light. And when it appears, it's one of those candles that I don't use for anything. A lot of traders ignore them entirely. They're a complicated pattern to even see when it happens. But as you can see in a downtrend, you had a long body candle where the bulls were in complete control. You then went to a small star candle, okay, and then moved to a bullish candle. Okay. Is this telling you that the markets are reversing? To me, it's telling me maybe the bulls are selling off to take some profit, or they just got exhausted after their long run. Okay. This is a very complicated one, and it doesn't have much reliability, but it's one that most traders should know. Okay, to summarize, the Morningstar pattern consists of the following. The first candle is a long red candle during an ongoing downtrend, and this candle represents strong bearish sentiment. The second candle is a very short-bodied candle with either a red or green with long wicks. This candle represents sudden break in bearish trend with indecisiveness. And this is where the fallacy is. It could just mean that the bears are tired for a second, taking a breather. The third candle, a green candle which is more than half in length of the first red candle. This candle represents a comparatively strong change in the sentiment towards the upside. Okay. Then we have the exact opposite in a uptrend for a reversal, and this is called an evening star. Okay. It's just the opposite of the moves. Okay. Now we're going to start, or for next week, we're going to start talking about the important ones. Triple patterns, and these are the 3 white soldiers and 3 black crows, which are very good trading patterns. And then we're going to talk about the 3 inside up and the 3 inside down. When these appear, they are very rare they happen, and they give you very important signals. Then we'll look at them in real charts and try to find these, and I'll show you some easy ways to scan many charts to find the signals. And then we're going to look at how we calculate where we put stop losses and take profits and how big these moves should be. But in the meantime, what I'm going to recommend is you study all of these 18 patterns so that you know them and recognize. Don't remember their names. Don't even remember exactly what they're trying to. Just know what they try to be able to interpret the story and be aware that that pattern is what this is what your eye is looking for, because these happen often. Okay, lots of them happen all the time, but I'll show you easy ways to find them. You know, like you're not spending every day spending your hours looking through charts, because today they're all computerized, and you can tell the computer or a scanner to pick them out for you. Okay. And then we're going to talk about which ones are really trading, or which ones you can use in other parts of a trading system to make trading decisions. So thank you very much for joining us tonight. And we'll see you next, what is today? Tuesday. Next Tuesday to finish up this class. And then the following Tuesday, we have a class on chart patterns and trend patterns, which will then incorporate using candlesticks into triangles, ascending triangles, descending triangles, and other channels to start using these to make solid trading decisions and understand and interpret the markets. So thank you very much for being with us, and I'll see you next Tuesday. Bye now.